Hi, my name is Portia Love, financial planner and owner of PSL Wealth Strategies and Management. Thank you for joining me today as I will be presenting one part of my series, Not Your Grandparents. Now, the reason the series is called Not Your Grandparents is because we will discuss the ways that various financial tools and strategies can be used in ways our grandparents either did not know or did not teach us. In today's workshop, I will be discussing life insurance. Now, please understand that this information is not intended to be specific tax or legal advice. I am simply providing you some knowledge, some information, my expertise. It is still important that you consult a professional advisor, a professional tax advisor, a legal professional, in order to make sure that the information you're wanting to apply is applicable to your own personal situation, as everybody's situation is different. So what works for one may not work for all, at least not in the same way. Now, a little bit about myself. I'm originally from San Antonio, Texas. I graduated from Southern University in Baton Rouge with a bachelor's in business management with a concentration in entrepreneurship. I'm also a member of Sigma Alpha Iota Music Fraternity Incorporated. I have over 10 years of default mortgage experience and over 13 years of being a business owner as well as working in the entertainment industry. I am the daughter and granddaughter of an educator, which is where my passion for providing information, especially information when it comes to financial literacy, to individuals that are seeking the knowledge. Now, the goals for today, you're going to understand, why do you even need life insurance? For any and everybody on the earth, there is a reason to have insurance, but why is it applicable to you? You'll be able to uncover why today. We're also going to learn about the different types of permanent life insurance. We'll learn about how these permanent life insurance policies are beneficial to you now, right? What's in it for me? And then lastly, we'll talk about some different strategies that can be used. Now, for most of us, our introduction to life insurance started with our grandparents, either the passing of our grandparents and finding out that they had a life insurance policy and that's what took care of the funeral, or them avidly telling us that we need to get life insurance because there's no way that we're going to leave and be a burden to our family, as well as they absolutely refuse to do another GoFundMe or fish fry. Now, sometimes they don't tell us what kind of life insurance we need to get. And honestly, sometimes we don't even ask. We just do whatever grandma or grandpa said because, hey, why would they intentionally tell us something wrong? Life insurance for so long has been a negative thing within our community because it's only supposed to benefit the people we leave behind, right? We've even been taught that you really should wait until you get older, when you're starting to plan for funeral arrangements and you're nearing death. That's when you want to get life insurance. Because you're pretty much saying with the purchase, I'm planning to die, right? That's what we've kind of been taught. And while, yes, life insurance does provide funds to your beneficiary through what we call a death benefit, today we're going to talk about life insurance, but this is not your grandparents' life insurance. It's not just a beneficiary only policy. We're going to talk about life insurance that will benefit you while you are alive. What I'm talking about is permanent life insurance. Now, even when we talk about permanent life insurance, some of us have heard about one, maybe two types of permanent life insurance options. But here's the truth. There's 4 options available. Before we get all into the weeds of each type, we're going to just high level go over what permanent life insurance is, because these things apply to all 4 types that we're going to talk about on the next few slides. So, permanent life insurance, like any other life insurance, yes, it's going to provide a death benefit that'll pay out to whoever you name as your beneficiary or beneficiaries, meaning you can have multiple. It is a little bit more expensive than a term policy because it is meant to last you the rest of your life, hence the term permanent. And that happens as long as there is either a policy payment being made every month in order to ensure the policy lasts, or you have enough cash value to sustain the policy without you making any more payments. Now, this cash value does have the potential to earn, to grow, and then when you withdraw, it'd be a tax-free withdrawal, meaning you're not having to claim it as income on your taxes. Now, I told you there's 4 types of permanent life insurance. So how your cash value grows is going to be determined by the type of permanent life insurance you choose. So let's talk about the one that we're all probably most familiar with. It's the one that grandma and grandpa probably had. It's the one we hear about the most. Whole life insurance. Whole life insurance is our, what I call our classic and secure, right? We know that if we make a particular payment every month, it's going to be the same amount. We know our family would have money to cover our funeral costs. But here's what we didn't learn. We did not learn that in addition to that guaranteed death benefit, we'd have guaranteed cash value as well. This is a guaranteed type policy, right? So if you pay that set amount, that guaranteed payment every month will guarantee you X amount of dollars building in the policy every month, as well as a guaranteed death benefit at the end. But what we need to understand is with guarantees comes an extra cost. So whole life insurance is the most expensive, generally the most expensive type of permanent life insurance. And that's because of the guarantees that it provides. So the next 3 types of permanent life insurance that we're going to discuss, they are a little less costly compared to our whole life, and that's because they provide flexibility in your monthly payments. So while there is a set amount that will cover your cost of insurance, you have the ability to do what we call overfund. That's that flexibility. You can overfund your policy. What that means is, for example, if the minimum monthly premium is, let's say, $25, right? This is just an example, but let's say your monthly premium is $25. You have the ability to pay 100, 150, 200, maybe even more per month in order to build your cash value. But you do need to be careful when you're taking on the strategy or the approach of overfunding, as there are limits set based on the amount of coverage that you have. So I would not suggest, if you're planning to overfund a policy, I would not suggest taking this approach or taking these steps without consulting an advisor. All right, so let's talk about the first type, which I call the stable and minimal, is our universal life. All right, so the cash value in a universal life policy grows based on either the performance of the market or the minimum interest rate attached to that policy. Now, Generally, you're not going to see a lot of growth in your cash value or performance of the cash value. So it's very important that you pay the monthly premium, maybe even a little bit more, just to avoid the risk that the policy could lapse. Now, this type of policy, I generally see our elderly individuals utilizing these types of policies. And that's because of that flexibility in premium or low cost that comes from the flexibility of the premiums. So they want the benefit of something like a permanent policy, like a whole life, but when you're on fixed income, it can become very difficult to maintain a whole life premium when you're in your 60s, 70s, and 80s versus utilizing a universal life policy where the cost is going to be less. They're not doing it for the cash value. They're generally doing it so that they do have a policy without having to pay so much out of pocket. Now let's jump to the extreme. This is what I call our flexible and risky. This is the variable universal life policy. Now, the cash value in this particular policy, it grows based on the performance of the sub account. Now, the sub account is invested in something like a mutual fund, so a combination of stocks and bonds. Now, this can serve as a double-edged sword, right? And that's because this means your cash value is not guaranteed. Everything we've talked about so far, we know you're going to have cash value. The reason why we can't guarantee you cash value in a variable universal life policy is because your cash value is 100% exposed to the ups and downs of the market. If the market is up 30, you're up 30. If it's down 40, you're down 40. You are going to experience everything that happens in the market based on what your sub account is invested in. There are no protections. You are 100% exposed to everything. Now, this can be a really great thing, especially if you understand the concept of buy low and sell high. Now, with life insurance, obviously, we're not going to be selling anything like we would in a brokerage account or any other type of investment account like a 401k or an IRA. You might, if need be, sell out of your IRA. But we're not selling in our life insurance policy, right? So the thing that you take advantage of is the concept of overfunding, right? When the market drops, when whatever you're invested in drops, you're going to put more money into your life insurance policy in order to maximize the ability to purchase and grow your cash value. And then when the market goes back up, when those funds that you're invested in go back up, you'll go back to making your normal payment in order to maintain the cash value that you've built. Because remember, you bought low, you bought it on sale, and then it grew when it went back up. And so you want to lock in those earnings. You'll do that by at least maintaining your regular monthly premium payment. Now, the downside to a variable universal life policy is obviously, yes, that you're completely exposed to the market. But here's the other thing, and this applies to actually all of the universal life policies, is that your cost of insurance is going to increase every year on your policy anniversary date. So if the date your policy was issued was June 12th of every year, you're going to have a small increase. It's a percentage. It might be 8, 10, 12%. Your premium will increase by that amount. You'll need to check with the insurance company to find out what that is, but you do have an increase in the cost of insurance every year. Now, why is that important, especially with this? Remember, you're fully exposed to the market. So if you stop making payments or you pay less than the minimum expected and the market drops, now you've got a drop, an increase in costs, and the company's pulling from your cash value in order to make your payment. So it can put you in a position where ultimately you could be at risk of losing your policy, meaning it lapses. So that's another reason why you definitely want to take advantage of overfunding it up front for as long as you can for the maximum amount that you can. Now, I will say that I do call this policy a strategy policy. And the reason is you can tell there's a lot that goes into this policy. You've got to keep up with market changes, cost of insurance changes, um, what the things that just happen in life, the fact that you're fully exposed to the market. This is not a policy that you want to go into without fully understanding how it works and having somebody that can help make sure that you stay on track with this policy, because most of the time, if you're getting this type of policy, it's to take advantage of really building cash value because you're comfortable being in the market. So you want to have an advisor that is knowledgeable with variable universal life policies to guide you along the way as you utilize this particular type of policy. Again, I would say this is a strategy policy. Now, lastly, we will discuss index universal life. Now, to me, this policy, and I call it the resilience and growth, this is like the combination between whole life and variable universal life, right? If those two policy types got together and had a baby, it would be index universal life. And the reason I say that is this: the cash value, first of all, grows based on participation in an index. So think S&P 500, Dow Jones Industrial, NASDAQ, your indices. That's where your cash value is going to grow, is based on the performance of the index you're invested in. Now, if this does not, if the index you're invested in, let's say, performs at a negative 10, 20, 30%, unlike in the variable universal life, you won't experience that loss like you would in the variable universal life. You'll actually get a credit, a minimum interest rate credited to your cash value, kind of like the whole life, but not exactly, but you're not experiencing those losses like you would in the variable universal life, right? So you do get a guaranteed minimum interest rate. The downside is there are cap rates and participation rates with the index universal life. So remember, with the variable universal life we talked about, you're completely exposed to the market. You're going to get the ups, you're going to get the downs. With whole life, you have a guaranteed rate. This says you're not going to have any loss. You'll have a minimum credit. And if, let's say, you're invested in the S&P 500, there may be a cap, meaning a ceiling on how much you are able to earn. So if the S&P 500 does, let's say, 20% or 25% for the year, you may only get 10%. But when the S&P 500 does at negative 25, 30%, you're just going to get whatever their minimum interest rate is. So it has its pros and its cons. You won't get the downside like you would in a variable universal life, but you're also not going to get the same kind of upside because there's a cap. You still have your flexibility in premium, which is great because you still can apply the concept of buy low, sell high, and overfund your policy. When the S&P 500, for example, is down, you can put more money in to your policy. Now, with all of these policies, our maximum goal is that we build cash value, because the cash value that's growing, what we're looking to do is pull from it tax-free and use it for whatever we want at whatever point in our life we want. So that doesn't have to be that you wait until you're 59 and a half like you would with your Roth IRA. You can use it in your 20s, your 30s, your 40s to, fund the purchase of your first home, your dream car, a nice vacation, and an investment property. You can treat yourself to a trip. You can literally use it for whatever you want, whenever you want, with any of these four types of permanent life insurance that we discussed, whether it be whole life, universal life, index universal life, or variable universal life. They all build cash value, but they all build cash value differently. So your goal, your purpose, your intent all boils down to is going to determine which type of policy, permanent life insurance policy, you decide to use. Now, if you do have questions, you want more information on these different types of policies, some guidance on which one may benefit you the best, or just want to make sure that the policy you get is structured in a way that you know is going to benefit you, my information is here on the screen. You can email, you can call, you can visit my website. And if you scan the QR code there, you can actually book an appointment with me at no cost to you. We can sit down and discuss more in depth the policies that you have to get clarity on that, as well as if you are interested in additional policies or getting a policy in general, I'm here to assist. But I do thank you for your time today. I hope that you learned at least 2 to 3 things new that you'll be able to take and apply in your day-to-day life as you continue to build and grow wealth for you and your family. Thank you again, and you all have a great day.